What's up, everybody? Welcome to the Life Cycle of a Trade, the series where we break down the thought process behind trade entry, trade management, and closing order. In this video, we're going to cover a short put spread. One thing that's been moving in the market this week, oil futures. So if you look at /CL, these are the crude oil futures. We're trading at 58.80 right now, but the futures have moved significantly over the last month or so. We've gone from, the 70 handle down to the mid 50s, 55, kind of the lower mark here. You've had all sorts of stuff from geopolitical stuff to wars to recession fears, all sort of things that have been affecting oil volatility here. You can see volatility at 55, the IV rank. If you wanted to actually pull up the actual implied volatility, you type in ovx.cgi. This is the crude oil volatility index. It's a VIX style volatility index for oil futures. It comes to you from the CBOE here. So when you look at this, it's about a 41 right now, which is pretty high considering where oil typically trades in the 30-ish handle for implied volatility, and the fact that oil typically has call velocity. You have call skew typically to the upside. Oil is thought to have, oil and a lot of commodities are thought to have a perceived price floor, meaning they can't be zero. So when these commodities like oil or gold or silver, when they move higher, you typically see volatility expand. You're actually seeing volatility expand into what is a relatively low point for oil when you look at it on any sort of time frame, save for the negative oil print we had during the craziness of the pandemic. But anyway, oil has seen a huge drop lower. Volatility has certainly expanded here. When you look at oil futures, you have to keep in mind which oil futures you're trading. So the M contract is right now the active contract. That is the front expiration contract. Here you can see it's trading at 58.83. The back months are trading at different prices. So 58.42 and so on. You can see there's a little bit of a backwardation there. A contango in the back with the oil futures. But I'm going to be trading this further out contract, trading at 58.44, so a little bit lower than where we're at right now. And my thought here is, you know what? I'm just going to sell a put spread into this move. And typically when we look at put spreads, I go somewhere between the 20 and 30 delta for the short options. I'm going to look at this at the 55 strike. And then depending on how much capital you want to use here and how much risk you want to put on, I typically go 1 or 1.5 points wide. Now with oil futures, 1 point is $1,000. It's 1,000 barrels of oil per contract. So this contract itself is a $58,000 contract. So it's a big contract here. So for me, when you go 1 point wide, it's $1,000 in total risk here. You can see it's $733 max loss, $270 max profit. That's because it's a 10 multiplier here, so 27 cents is $270. You can see with span margin, you do get a little bit of extra buying power relief. That's relative to volatility, proximity to the strike price, how much time is left until expiration, notional value. All those things kind of play into what your span margin will be. Now for me, I think I'm going to put a little bit extra risk on here and do a 1.5 point wide spread. I'm going to go to that 55 handle. That's kind of the low where we've seen there's all sorts of levels around the 53 or 52 to 58-ish range is kind of where production in the U.S. starts to kind of halt because of the price and just the cost of production. So I think that this level will kind of hold. So I'm going to go towards the 55 strike for my short, 53.5 for my long option. We're going to try and get filled here. Let's try above the mid price and work our way down here. Oil has been moving quite significantly here. So let's adjust this here. We'll go down 37. All right, so we're in at a 37-cent credit, which is $370. We've got about $1,100, almost $1,200 in total risk on the trade, but only using about $900 in capital. So we'll see if this one plays out. Stick around because we're definitely going to have to manage this moving forward. All right, we got some beautiful pre-market action here for us in the Johnny portfolio. Oil futures at 63.07. It's been just a couple of days. We've had this really big move to the upside. It's time to go on this trade. There's not much more to say about this other than that we got a good timing on this trade. It moved very quickly. You got a little bit of a vol contraction. There's no point in holding out for any more on this trade. We utilized the futures, which gives us extra leverage here, so it's a relatively big position from a risk perspective. It moved very quickly. It's about as good as it gets here. So I wish there was a story to tell in terms of management here, but this one is just a good trade that went pretty quickly. So we're going to close this out here. Again, the oil futures, it's $10 per tick. So, every time you move this, if you move this from 14 cents to 15 cents or 13 cents to 14 cents, it's $10. So it's a lot of money. Try and get filled at the mid price, and then we'll work our way from there. So we're going to try 14 cents, see if we get filled here. No fill there. Go to the activity page, replace this one, go to the 15. So there we go. We got filled on that trade for 15 cents, which is $150. We sold it originally at 37 cents, which is $370. So we made 22 ticks, which is $220 on our oil short put spread in just 5 days. It was a perfect trade. Good entry point. Got the move we needed. Closing the trade. Time to go. Use that capital elsewhere. So good trade for the Johnnies. We'll see you next time.